Hello, this is Jim Ammerman, Managing Director of Wealth Planning at Fortress Wealth Management. And this lesson is going to cover the decision on Roth 401k versus traditional 401k contributions. And this methodology is going to also be applicable to traditional IRA versus Roth IRA contributions as well. So it's all about what the true marginal tax rates are now and versus in the future, and then factoring in capital gains tax also. So we have the two scenarios here. We've got a Roth 401k contribution column and traditional 401k. We're going to assume our subject is at least 50 years old, so they can contribute the maximum 27,000 next year. And if they were under 50 years old, that max would be 20,500. We're going to assume they have earnings of 100,000, and the deductions are then going to be different. On the traditional 401k, you get to deduct the amount you contribute. With the Roth, you do not, and that is because the contribution grows tax-free. You would have required minimum distributions when you turn 72, but you can roll that into a Roth IRA to avoid those requirements. And the total, if it's not spent, would pass on to your beneficiaries, your kids, and they could pull it out 10 years after your death with 10 years of additional tax-free growth. Whereas the traditional IRA, you're going to have required minimum distributions, and when the beneficiaries receive what's left, they're going to owe tax on that, and that's going to have to be distributed and taxed within 10 years after your death, typically. So now we want to look at what is the current true marginal tax rate. And I say true marginal tax rate because your tax brackets, the top bracket you hit, is not going to tell you the whole story in every situation. There are what I call tax levers out there. And I have a video called How Your True Future Marginal Tax Rate Can Be Much Higher Than Your Tax Bracket. And some of those levers are Social Security benefits taxation. So as you have more income, the taxation of your Social Security increases. The capital gains tax gets higher the more income you have. And Medicare premiums, the more income you have, you're going to pay more in Medicare premiums. There's Medicare surtax and net investment income tax. There's qualified business income deduction changes that occur as your income goes up. So all these things can make your true marginal tax rate higher than just what your bracket is. So in this current year, we're going to assume there's no levers, and it's just a straightforward 24% federal rate plus a 9.3% California rate. And that's in both scenarios. So on that 100,000 earnings, you've got 33,300 of tax. And in the traditional scenario, it's going to be a lower amount of tax because we have that deduction. And if we look 25 years out, assuming 7% growth per year, we've got 146,000 in both cases. But we also have additional money in the traditional scenario because there were tax savings when this contribution was made. So the difference between the tax on these two, which was almost 9,000, we're assuming that was invested, and over the 25 years grew to 49,000. And that growth is going to be taxed at the capital gains tax rate. So articles and guidance on Roth strategies, pros and cons, almost always ignore the fact that there's this capital gains tax issue. And they say it's all about just comparing the marginal rate now and in the future. It's not quite that simple. As I mentioned, there's tax levers that can add more to your marginal rate. And there's this capital gains factor too. So there's 9673 of capital gains tax. And there's going to be taxation when you withdraw the traditional 401k balance out. I've applied this 26.7% rate because I found that to be the break even in this scenario. That's what made the total net after-tax funds almost equivalent here in gold, 146 versus 146,000. So that means that if the tax rate in the future was lower, the true marginal tax rate was lower than this, then the Roth 401k would have been not the ideal decision, and you would want to stay with the traditional 401k in that specific year. And every year is going to be a new scenario that you want to analyze. So if the tax rate, true marginal tax rate, including the levers, is going to be higher than that, then the Roth 401k is a good choice, because that would be a higher number than this reduced amount due to the higher taxation. As I said, this same methodology applies to IRA contributions, which have a lower limit, 6,000 and 7,000. And we have $28 trillion in US debt, so future rates are probably going to be higher. The Tax Cuts and Jobs Act expires at the end of 2025, so rates are expected to go up anyway at that point. So count on higher rates in the future. Maybe you would still be below this break-even point and want to stick with the traditional 401k, and that's going to be applicable for a lot of people. But like I said, this is an analysis you want to run every year. Ideally, you want a CPA that has expertise with the best financial planning software, who's going to coordinate with your tax preparer CPA and run projections that calculate the taxes every single year going forward and how that affects your net worth. And then you can determine which Roth strategies are the most prudent and what's going to improve the net worth long-term the most. And you're going to include all the tax levers that could affect your future as well. So if you have any questions on this, if you want to get a free customized assessment on your situation to see which Roth strategies make sense for you this year or next year, go ahead and send me an email to jim@fortress-wealth.com. And thank you very much for your time.